Good morning and welcome to LMAX Exchange 2017. It's set to be an interesting year. First of all, framed by the volatility we should expect given the new style of presidency in the United States, given the known unknowns in Europe, of course with the Brexit situation, but then further afield, the upcoming elections in the Netherlands, in Italy, in France. So that should be good for vol traders, good for exchanges, and hopefully good for our clients. Then under that macro view, we have something very important happening in the FX market. People are now questioning the existing market structure and that status quo that has existed for some time. We have the much vaunted Global Code of Conduct coming in May, so let's see what's in there. But what's already clear is that a lot of the players in the market are already starting to focus on greater transparency, greater efficiency, and greater fairness in our treatment of clients. At LMAX Exchange, we've preached that maybe for the last 6 years, so we welcome that deeper dive into the cost of trading and efficiency of markets from a client's perspective. Now, we've heard for many years that last look liquidity and firm liquidity is a case of choice by the client. We agree. If a client chooses to trade with last look, so be it. But in order to make that choice, we have to educate the client so that they can make an informed choice. Until now, I feel that hasn't been available for clients. So what should you consider when you look at your style of execution and the style of liquidity you hit? Broadly, there are 5 things, and these are 5 things that we will investigate in more depth in the coming weeks. First of all, it's obvious. There's spread. Secondly, there's the cost of rejection if you trade on last look. The cost of a hold time if you allow that one-way optionality of last look for your liquidity providers. And then, of course, there's price improvement. And finally, there's market impact post-trade. You have to be able to calculate all of those things to make an informed choice as a client. Now, I'm happy to see that a lot of the liquidity providers are starting to do that. And we ourselves will publish that information on the LMAX Exchange in the coming weeks and months. And I think we'll be able to prove that in most cases, given a reasonable spread, the cost of trading is always lower on firm, no last look prices. To give you a quick snapshot, I suspect the analysis will come out that spread is always a bit wider on firm liquidity, but there's never any rejection. So therefore, the cost of rejection is 0. There's no cost of hold time. That's also 0. Price improvement is standard. If you're not getting price improvement from your liquidity provider, you need to ask why. As an example, last year we paid at least $2 million to our clients in price improvement, which comes as standard on any central limit order book, and of course on the LMAX Exchange. Going back a little bit into the cost of rejection and hold time, we estimate that to be between $25 and $30 a million on a 100 millisecond basis. Incidentally, at least 2/3 of that cost happens in the first 10 milliseconds. So when you add all those metrics together, you get to the true cost of trade. And I think only now in 2017 will you as a client be able to make a fair assessment. So they all deserve their own time, their own investigation. We'll try and do that in the coming weeks. So stay tuned. In the meantime, I wish you luck with all your trading in 2017, starting with the inauguration of the new president. Thank you.